is July 23rd, 2025. My name is Ben Reppond. Welcome to my broadcast. I'm going to give you market insights today. Now, I did this, something that's a little different, is that I did my research on this Monday morning, the 22nd. So it'll give you, when I say things are for the last week, it will be as of Monday morning, not as of Friday afternoon. So that is a little bit off, but it's not much. So I just give you that as a disclaimer. Okay, so for the past week or weekend, a little bit more, in the yellow box, you can see that all of the major indexes, including bonds, long-term government bond, TLT, are all up. Many of them up slightly, but they're up. On a year-to-date basis, you can see in the red box, they are the ones that are up the most are emerging markets and developed markets, and then behind that are the NASDAQ 100, and then it drops off quite a bit after that. And even on a year-to-date basis, government bonds are negative. On the far right, the green dots indicate that they are above their moving averages, going from left to right. They're 20, 50, 100, and 200-day moving averages. And then bonds are slightly below their 100 and 200. On the sectors, and you take the S&P 500 and you break it apart into 11 major industry sectors. Most of those are green, positive, above their moving averages. And for the week, 8 out of 11 are positive. And for the year, 8 out of 11 are positive. And you can see the detail of that. The ones that are the most positive are industrials, technology, and telecommunication. Okay, the S&P 500 looks like this for the last year on a line chart. So I take it from October of 2022, not quite 3 years, until today, and I draw a black line. You can see an arrow, you can see that, and where it's going at the very tip on the upper right corner, you can see the degree to which the S&P 500 is continuing to accelerate. Now, there are people, lots of them on the internet, on YouTube in particular, money managers, well-known economists and financial people who are talking about all kinds of negative. The market is going to collapse. We're headed for a depression, a recession. The banking system's at risk, the dollar's at risk, the market's at risk, bonds are at risk, etc. I mean, it's just full of that. And so, and meanwhile, including today, and I'm recording this on Monday, the 22nd, the continuing to make new highs, continuing to go up and up and up. So defying what people are afraid of and thinking is going to happen, maybe it will. I do believe that at some point the market is going to collapse, and actually the higher it goes, the more risk there is that it is going to collapse. But right now, it's got a head of steam, and what is that based on? This year, a lot of the movement has been based on tariffs, either the fear that they're going to occur, and that what that means for the economy, for the consumer, for retailers, wholesalers, and those who are manufacturing and so forth. A lot of implications, and the fear is those are negative. When that started to change in early April, then the market took off, and you can see that in the very far right. I'll show you another chart that'll make it even more obvious. So on both the negative side and the positive side, tariffs have been, in my opinion, the biggest driver of the market. I put that on a candlestick chart, and it looks like this. So the hollow candlesticks show more of an upward movement in the market, and the red candlesticks show a point where it starts here in the beginning of the week and then goes down, and that makes it a red candlestick. This gives you, this is what I wanted to show you. This is year to date, just January 1 to present, and you can see there are really two markets. One market where it goes down until April 7th pretty sharply, and then the other market since that time where it's been going up. Again, I think this is tariff driven. So the fear that exists in the first quarter or so, and then the optimism that it may not be as bad as we think, or other countries are coming to the table, or there's counter tariffs, all kinds of things that go on that cause the fear that existed in the first quarter to not exist in the second. So it's a really good example for me to say this is the way the market works. It sometimes defies logic. It certainly sometimes goes a different direction than what you feel or what you think. And because what you feel and think is valid, it just sometimes doesn't apply to the stock market. The NASDAQ 100 on a relative strength chart, being the numerator, the S&P 500 being the denominator, looks like this. This is a 3-year chart. So it shows that as it goes up, this favors the NASDAQ 100, which is primarily driven by large tech companies, and compared to the broader market, the S&P 500 denominator. So it goes up, NASDAQ, goes down, S&P 500. The S&P 500 has growth stocks in it, again, primarily technology, and it has value stocks in it. But it is a broad indicator of the market. When I compare the growth side of the market to the value side of the market, growth being numerator, value being denominator, it looks like this. So again, here you see a lot of down and a lot of up, some extremes, again, favoring either growth or value. Excuse me, the S&P 500 compared to the Russell 2000 small cap index, represented by IWM, the ETF for small cap, it has, at the very far right, you can see that it has come down for the last few months, more than go up, and that tells me that small cap is starting to come back. And so when it goes up, it's favoring large cap, goes down, it's favoring small cap. It's not an indicator of the market itself. It's a matter of favoring which segment of the market is more in favor. Long-term government bond, represented by the ETF TLT, gave you a 5.5 year chart, and you can see it drops a lot over that period of time. At one point, it was down 50% or so from its high. This has been horrible for stock portfolios that rely on stocks and rely on bonds, because this is a kind of a proxy for the bond side of the market. Now, there are also short-term and intermediate term and corporate bonds, and I didn't show them, but this gives you when bonds are doing well, this ETF usually does the best. I measured this also from September of 2024 to present, and from beginning of April, or you could say the end of March to present. This gives you an indication of the degree to which bonds have performed. In that period of time, bonds, by my black arrow, bonds are negative. The dollar has been under attack a lot, and as I've covered gold, I covered in yesterday's video, and I'll cover it some today. As the dollar goes down, gold tends to go up. Not always. It's not an exact they're not exactly non-correlated, but there is you can see that the dollar definitely has a lot of pressure on it, and of course gold and silver are being pushed upward at the same time. Here is the chart of gold, showing this is a 3-year chart. showing where it has been going. It's been a very steady move up. Plenty of down periods, but they're very short and very shallow. So at the very end, you can see it's still moving in an upward direction and still above its 20-period moving average. Silver, same thing. It's more volatile. It has more extremes on ups and downs. Right now, it's moving in an upward direction very positively and well above its 20-period moving average. Bitcoin was up slightly and has been moving in an upward direction and also well above its 20-period moving average. Volatility, when the market goes up, that reduces volatility. When it comes down, volatility goes up. It's inversely correlated. And as the market has been going up lately, equity markets, the volatility index has been coming down. So from its high back in late March, early April, it has been dropping, and you can see where it is today. It's down around a little over 16, and it was up around 45. And I think on an intraday basis, I think it was, as I recall, I think it was up around 65. I use South Korea as a proxy here to just show the value of the market at the S&P 500 compared to foreign markets. And you can see as this drops, pretty much a steady drop from late December to present, that it has done that. That represents the strength of South Korea and also the strength of other markets compared to the U.S. market. Prior to that time, the U.S. market was strong. The dollar, I should say. Okay, gold and silver. So this is as of today, and I'm sorry I called it July 22nd. It's actually July 21st. So as of today, the spot price on gold is $33.98, up 1.3% from July 11th, which was Friday a week ago. And silver up 0.6%, 0.6% from the same time period, is now up to around $39, and that's the spot price. The gold-silver ratio is 87-1. A monster box of silver, 500 rounds of generic silver, is $20,100. If you watch this regularly, do you remember how many months ago? Not very many, when it was 12,000. Maybe that was 6 months ago, not very long ago. 20,100 for 500 rounds. That includes $1.20 per ounce over spot markup, and that brings it to $40.20 per round. Now, in yesterday's video, I covered this with my son, who's a retailer, and he tries to be under the price, particularly for a monster box, tries to be under the price of SD bullion, and he told me this morning his markup is $1.20. SD bullion, which is the standard, is $1.50. So that was the degree to which he was under their pricing. So when I ask him, I say, "What are you charging?" He just goes to their site, looks what they're selling it for, and he says, "I'm going to sell it for less." Okay, if you have questions or comments, leave them in the comment section below. Thank you.